I had to adjust my saving.
The goal that you're trying to get to with your, and that's to me, I think.
Diversification fits into it. So the long and the short of it is.
Absolutely. How about at the end of the day? Do you do anything? Like, I'm really fascinated by rituals and things like that.
So I think it's really important to be ethical and actually paying them well above.
Innovators is that when you look at a property perspective, it's your home.
Hello, good afternoon, good evening, good whatever the case may be, wherever you are. I hope you're well. And if you can hear me, hello. Unfashionably late as per usual. So I do thank you for sticking around. I realized I had to get my lozenge because I'm still struggling with my voice. It's one of those things where I want to get back into it and I'm keen to do all these live shows. And my voice is just letting me down. So I also just need to turn off some of my notifications here. So apologies. If you can hear me, let me know in the chat. If you're joining us on Facebook, YouTube, wherever you may be, say good day. I was in the YouTube chat just a little bit earlier on, just trying to rally the troops. It's old Slack. Here we go. This is the thing that's giving me the irrits. Hello, Jordan Kiddis. Good to see you, my friend. Always. So today we're talking about ETFs. I've got a lot to get through. And if you didn't tune into Tuesday's session, that's okay. Hi, Kylie, over on Facebook. Can hear Peter Moyes. Thank you. If you didn't tune in on Tuesday, it was if I dare say so myself, I was actually telling my wife how good I thought it was. And she's like, of course she thought it was good. You're the easiest person to convince. But if you haven't already seen it, I'm going to refer to some of the things that I spoke about on where is it? Here we go. I'll bring it up for you. On YouTube, I'm going to reference some of the things that I talked about, which was, where are we? I think it might be back a little bit. No, in the live. I'm going to reference the Aussie shares one. So this one, there are a few charts that might be similar. So if you like today's show and you think, oh, this guy's all right, might go listen to some more of what he had to say, go and have a listen to that one, the Australian shares one. Vigis, good to see you. Connor, everyone, thank you for joining me. I hope your day is going well. So typically we do these every Thursday midday, and you can join me. I'll be here every week, voice permitting, of course, but seriously, I'll be here every week. So the first three sessions in this new Rask Invest live series, we've used a Charlie Munger quote. So while we stop now, here's the quote from the late, great Charlie Munger. It is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent. Graham, good to see you. So Charlie's other quote, which is a bit more blunt and a bit more like him, is that instead of seeking brilliance, just avoid stupidity. And I think there are a lot of things in our lives where instead of trying to be a hero and instead of trying to be the best, just try not to be the worst. And investing is one of those games where if all you do is that, statistically, you have a significantly better chance of retiring wealthy or just growing wealthy and providing for your family or the community around you. And I'm going to illustrate some of those things today and explain how you can do that through the lens of ETFs. We're going to talk about the most popular ETFs. We're going to answer your questions on ETFs. We're going to talk about managing an ETF portfolio. We're going to talk about all that sort of stuff. But if you haven't already subscribed, well, to be honest, I don't know if there's any help on you. But seriously, jump on YouTube or Facebook. We're more prolific on YouTube than we are anywhere else at Rask. So if you haven't already checked us out on YouTube, go and do that. General advice warning, as per usual, anything that I do mention today is limited to general financial advice or general financial information only. I don't know your personal needs, goals, or objectives, your financial situation of needs. So please refer to a financial planner who can take into account those things and give you one-on-one advice. Finally, if I do mention Rask Invest, even though this series is called Rask Invest Live, we have an investment platform, an investment service called Rask Invest. So if I refer to this Rask Invest, like how we invest people's money in our community, that you should know has a PDS and a target market determination. Now, I don't just come out here just to talk my own book, but if I do refer to it and you're confused, just remember there is a PDS and a TMD, and you can access them on the Rask Invest website. Obviously, all the links to everything, including our partners at Navexa, Superguide, even Pocketsmith, everyone that supports the live show, you will find links to those in the show notes. So that's when I say that sort of stuff. Let me just bring this up. What I mean is when you click on the description area, all the links are here. So go and check that out. Now, back to the task at hand. So Rask Invest Live every Thursday, midday. It's free. It's practical. You can keep the conversation over in our community, which is also free. People love that, and it's great to see everyone in there asking us pretty curly and fun questions. Financial Freedom, good to see you. Banana Man, hope you cover DHHF. Hey, Banana Man, if you're willing to stick around until the back end of the show, so like in about half an hour or so, I can answer. I can talk about DHHF as well as the diversified ETFs. It's a really common question I get, as well as bonds. Otto, you've used EFT instead of ETF. That's a common little typographical error people make. So ETF, exchange traded fund. So in this session, I'm going to talk about ETFs. I'm going to talk about it. We're not talking about the absolute basics, but here it is. If you are new to ETFs, here's the absolute basics. An ETF is bought and sold the same way you would buy shares, like BHP or Apple shares, exactly the same way. The difference is when you buy an ETF, you're getting a basket. You're not getting one individual share or one individual bond or one individual thing. You're getting a basket. So you buy the basket. The example would be, imagine it's your partner's birthday and they're interested, they like flowers. Instead of going to the florist and just picking one flower that you think might be a good one for them and you don't really know, you just go in and you get a posy. You get the whole posy of flowers. You're buying the posy. You're not buying the individual thing. And that's really important because we're going to talk about some things today about why it can be difficult to buy individual shares and why sometimes it's appropriate, but a lot of the times people do it wrong. It takes more of their life and their time, and they make a lot of mistakes, even professionals. So this is where ETFs come in. This is where a core and satellite philosophy comes in. But in short, an ETF stands for exchange traded fund, and you buy and sell it exactly the same way you buy and sell a normal share. You need a brokerage account. CommSec, Perla, and SelfWealth are the three most common brokerage platforms in the Rask community, and three that I'm happy to mention here on the show. So that's the common way to do it. If you invest with us, we buy the ETFs for you. That's the difference. But anyway, enough about that. So today we're going to cover out why ETFs are good for the core, how to invest in them, how to research ETFs, the most popular in Australia, and I'll answer your questions about them, tax and admin, and so on. So last week, and I said I would reference some things. Last week we talked about this wonderful chart from Vanguard, which is produced constantly. It's called Vanguard Interactive Chart, or something like that. You can go and Google this if you want, or you can go back to last episode. But basically, what I posed to you in the last session of Rask Invest Live on Tuesday was that over the ultra long term, shares have been the best investment, bar none. There's been nothing that has been better than shares. Even the mighty property, whatever, it hasn't been as good. And definitely nothing has been as good all around the world as shares. So not just the Australian share market, but other stuff. Now, that doesn't mean that some properties or some individual shares do better than others, but on the whole, the share market. And in short, the reason why that has been the case is because the share market is where innovation happens. It's where people go, they've started great businesses that solve society's problems, and you can invest and support them. And if they're a success, you benefit. That's the simple gist of it. And people tend to forget that, and they tend to think it's like a casino. And we talked last week about why gambling should never be compared to shares, because gambling is a horrible thing and it actually ruins society, whereas this actually supports society. It's just that people make you think they're similar in order to extract more money from you. So, Tarwin, so good to see you. It's been too long. We're back every week, and Owen too in the chat. So good to see you. Megan, you too. So good to see you guys. We do these every Thursday, and I do have laryngitis, so I do have a lozenge in my mouth, and I apologize if I lose my voice halfway through. But anyway, we talked about why the share market is this brilliant thing. But last week, you might remember that I pulled out these charts and I showed that US shares are really good, Australian shares are really good, international shares. So it's the Vanguard index, interactive charts or something like this. And you can go in and you can analyze it by British ministers and so on and so forth. But what importantly people tend to forget is that not a lot of people actually get the return that you see on the screen in front of you. Not a lot of investors actually get to experience this massive run up in prices. Not many get to experience even these ones right here. Why? One, they try and pick stocks. Two, they also don't have the behavior. They don't understand what they're doing, so they freak out at the worst possible times. And three, things get in the way of compounding. I showed you last week that 1 in 5 years, using 124 years of market data from Market Index, that's the website you can visit, shows that 1 in 5 years, the stock market is negative. People tend to forget this and they think that every year should be positive. It's not. And 1 in 5 you can often get 2 of those in a row, which is a bad time. And not just negative, it can be falling 20% one year and then 20% the next year. And then you're like, what the hell is this share investing thing? So times can be bad, but the long term is positive if you zoom out. Keep that in mind. So now we know that the share market is great. And I'm not just saying that because I do it. Like anyone can do it. If you want a validation, just look at the Forbes rich list and ask yourself how all those people made money. It's because all of them invested in a business or started a business or they inherited money in the case of like the Walmart family and whatever. But that's how it works. It's not positive every year. So what we really want to do is we want this chart. And this chart explains a few things. One, it shows long-term compounding. It's kind of looking like this chart, these charts here. But you'll notice if we zoom in, I've put like little circular arrows here. And what it basically shows you is that you want to develop good habits and you want to keep those good habits compounding. So if you imagine that every one of these little bubbles is like a year of you saving and investing, saving and investing, saving and investing, saving and investing, saving and investing. We call that dollar cost averaging in finance lingo. But basically what it means is that in the short term, you don't actually know if all this saving and investing is actually doing anything for you. But eventually those habits form and they compound into something brilliant over the long term. So that's what you can see there. And that's what we want. And the beauty of ETFs are, because you're not worrying about each individual stock, whether Apple's up or Google's down or BHP is a better dividend stock than Rio Tinto, because you're not worried about that stuff, you can just sit back, focus on what you can control, and you can just invest in an ETF. And that's why they're so powerful. Obviously, this is all about ETFs, so I'm making the case for that. One of my business partners, Jamie, he once got on stage and tried to compare a plate of food to building a portfolio. Now, Jamie walked off stage and he was laughing and he was like, I don't know if that works. But I thought it worked. And if we think about what a plate of food normally looks like, there's a bit of this, a bit of that. You know, you might like porterhouse steak. I might not like porterhouse steak. You might like potatoes. I might like sweet potatoes. What it really doesn't, what matters is not which porterhouse or which cut of meat you like or which potatoes. It's just that you eat something that's good for you. That's all that really matters. And you've got a bit of this and a bit of that. You've got a full plate of food. It's the same with investing. When you use ETFs to build a portfolio, it's not which ETF is the best one and going to create all the wealth, and then you spend a year trying to figure out which one is the best. The key thing is that you stay invested and you just get on with it, even if it's negative. That is the key thing. And the finance industry does not want you to know that, because if they just tell you just to stay invested, don't trade, don't look at your portfolio today, it's bad, just keep going. If they tell you that, they're not going to make any money. So that's why they don't tell you about it. So don't stress, even if you watch this show today and you think, which ETF? Just go and buy one. Like, we've already got a comment here, a great comment from Luke. It says, I already hold a small position in A200, but I like the quality tilt of AQLT. Would love to hear your thoughts on this ETF. Luke, if you remind me when I get to that, yes, I'll answer that. But the reality is, both those ETFs are good, and both of them serve a position, but that's not a one ETF rules everything situation, even with those diversified ETFs, which Banana Man mentioned earlier on. I don't think they're perfect, and I don't think they are right for everyone. The key thing is, that doesn't matter. What really matters is just that you're invested. So if you want me to actually put some science behind this, I've got some yummy finance science. If you want to take this home to the dinner table tonight, and while you're eating your meat and 3 veg, you can bring up this wonderful but extremely, extremely dense piece of academic literature. And it's debating semantics, finance acronyms, methodology, like all that crap. Basically, what studies show is it doesn't matter which ETF or which stock you pick. What matters for you to create wealth for you and your family is none of that stuff. The single most important thing that you can focus on is how much of each thing do you put in? How much US shares? How much Aussie shares? How much cash? How much bonds? That is it. Not which one, not which cash ETF, which global shares ETF, none of that stuff. Lamb, says Neil. Well, that would make sense, Neil. And g'day, Darren, over on Facebook. Good to have you with us. None of that stuff actually matters. What the overriding science shows is that somewhere between, let's say, 60% and 100% of the return that you will get from investing comes down to how much stocks, how much bonds. That's basically it. Or if you want to make it even more simple, just invest. That's it. But all this other stuff, like the daily AFR market update, the Bloomberg news, which are both great resources, by the way, all of these things, that's what I would call rent seeking. As in, they sit in your brain and they try and tell you that it's important, and they charge a fee for telling you it's important, but really it doesn't matter. What's really important is that you just keep dollar cost average and you keep investing. Even if you're in retirement, you just stay invested. That's the key thing. And that's what shows what really works. Gareth, you said, so being a retiree is not material for ETF selection. The most in thing, like, put it this way, Gareth. Most people, when they talk about investing, what they do is they talk about which stocks they want to buy, right? Imagine for a moment that instead of all of that time that we spent picking which stocks to buy, we just decided, how much Aussie shares should I have? Okay, well, I'll just pick the biggest one. And I'll come to that in a minute. That thought process is more valuable. And it also leads you to act less, meaning that if you just focus on the big picture, you don't feel tempted to buy and sell all the time, which means lower fees, lower taxes, and ultimately a better term return, a better long-term return. So I'll flesh that out in just a moment, guys. But ETFs are wonderful, even for beginners or advanced. We have 3 different strategies at Rask. One of them is just designed for retirees, and the other 2 are more growth focused. And we designed them that way because we knew retirees could use them just like we do. Karina, you said term deposits / savings accounts or cash ETFs. I'll go one better, Karina. You've come in and asked if you should have one of these things. I'm going to say, what about none of them? And I'm going to show you. There's a link in the chat now. What about ETF, not savings account? What about offset account? There are reasons that we do that. Now, Karina, if this is your first live show, you should know that what we're going to do, thanks to one of our partners, which is Navexa, over the next year, every Thursday, we're going to build a portfolio together. In the very first episode of Rask Invest Live, I'm just going to grab another lozenge, so 1 second. We put together this thing, which I've started to call it fake news portfolio, but if someone else has a better idea, tell me. We've started to build this portfolio called Fake News. Obviously, it's an election year, so you can get where that's coming from. And what we're going to do is we're going to build it out. But at the moment, what we've done is we've put all of the fake money, all of this fake $1 million in the AAA cash ETF. And the reason that we did that is the same reason financial planners use the AAA cash ETF. And the same reason we use it at Rask is because most brokerage accounts don't pay you any interest. And so if you just have random amounts of cash sitting in your brokerage account before you're ready to invest in it, it may as well be invested, assuming you've done the math, it may as well be invested in an ETF like a cash ETF. The reason cash ETFs exist is not why you think. It's not so you can compare the ETF to an offset account. It's actually because when your money is somewhere, it needs to earn interest. And a lot of those bank accounts and brokerage accounts don't pay any interest. So yeah, now that you mentioned them, Navexa is amazing. Thank you, Owen. So anyway, let's continue on. Let's talk about fees. The average fee on an ETF is less than half the fee on it's just about it, but let's say just less than half the fee of traditional managed funds. So straight out of the gate, ETFs are going to offer you lower fees on average. They're also much, much lower than listed investment companies, which are those things that are not ETFs. They're different legal structures, which I'll talk about in a minute. Aiden, you said, please purchase crypto for the fake news portfolio. Well, maybe it's a fitting investment. We can talk about that a little bit. But anyway, really, what fees do, not just fees, like I'm not against fees. I think the finance industry needs to earn fees so that it can be profitable and safe for everyone. But what the reality is if you think about the average returns that everyone watching this, including myself, will get, if we averaged out all of our investment returns over the next year, no matter what we invest in, whether it's property, crypto, shares, bonds, cash, doesn't matter. If we all averaged out our returns and we tracked our portfolio with Navexa or ShareSide or whatever, and then we got all of our 1,000 investor returns and we put the bell curve in, just like we did at school, an average, and then we just assumed that all of us had to pay 1% more in fees because we chose a bad investment, just the same portfolio, but 1% in fees, obviously all of us would earn less of a return. So it's obvious that the lower your fees, the better your after fee return would be. But there are implications to that. You can't just go for the lowest thing. So fees are important, and ETFs tend to be the lowest fee of the options that you will get to choose from. Another reason why ETFs tend to work is that ETFs offer diversification with one click. 20 to 30 years ago, when stockbrokers used to give advice to their clients on how to invest in stocks, what they would say is they would walk in and they would say, hey, Owen, so there's this idea which we like to talk about, and it's called a race to 30. We talk about this idea as a race to 30. You need to get 30 stocks in your portfolio so you're diversified. And people go, oh, that makes sense. Diversification. I've heard about that. Well, you don't have to do that anymore because some ETFs have thousands of stocks inside them. So when you buy one basket, you get thousands. Some ETFs have 10 stocks. Some ETF has bonds, all those types of things. You don't need to do that anymore. What you do need to do is you do need to diversify across different types of investments. There was a famous study done by Professor Bessenbinder of the Arizona State University, And what he and his team did is he looked at the stock markets around the world, the US, Australia, Europe, you name it, stock markets, right? All of them. And what him and his team found is what they were trying to show was how many of the stocks in the entire stock market did better than bonds. Because at the time, when you had a choice to invest, you could put it in a bond, which is boring and just pays you interest, or you could put it in stocks. So he wanted to know how many of those stocks actually did better than the most boring thing someone could do with their money. And what he found was, depending on which stock market you looked at, the maximum number of stocks that would do better than boring old bonds was at most 4% of the stocks. Let that sink in. If you had 100 stocks in front of you, Apple, Google, Netflix, Amazon, Starbucks, Walmart, BHP, Telstra, Combank, if you had 100 of those, what the data suggests is only 4 of them, at best, would do better than just picking a bond and just investing in that thing. So what this highlights is that it's very, very difficult to find the individual stocks. Now, I invest in individual stocks, and for long-running fans of Rask, you will know that Pro Medicus is up 3% today, and this is it's my longest-running stock pick, and I am still a very proud shareholder today, and I'm delighted to see it's up 15% this week, even though it is ridiculously expensive. So I'm not against individual stocks by any stretch of the means. I love all types of investing, but what I'm here to tell you is the reality is less than 4% in a good market are the number of stocks that will do well. If you go to the US market, it is at times less than 1.7% of stocks. So basically 2 out of that 100. Some markets are 1%. So when you look at all the stocks on the stock market, chances are most of them aren't going to be that good. But that's why ETF investing works. ETF investing works not because you are trying to pick the best ETF, but because even amongst all these, if you just pick them all, you're guaranteed to get some of the winners. A lot of people don't talk about this. They think, well, I'll just try and pick those yellow ones that do really well. Yeah, you could, but chances are you're not going to. So you may as well at least have a plan B, which is where you definitely are going to get some of them. And there's this wonderful book. It's called, I've referenced it 100,000 million times. It's probably on the bookshelf behind me. It's called Gorilla Game. And it was written in 1997, I'm going to guess. This one right here. And the book talks about how you can invest. This was at the time of the dot-com boom. And it talks about how you can invest in the world, in 1998, there we go. The world's best companies. The tech companies of that era. And basically what they concluded at the end is bloody hell. You might be thinking you're investing in a gorilla, but what you're getting is a chimp. And it's not going to work out for you. So instead, what you do is you cast the maximum widest possible net, and you just buy a bit of everything. And then once you know which ones are the winners, then you put more in those ones. Pretty straightforward. A lot of people don't do that, but that's this concept, except now we've got ETFs where we can own everything really quickly. So another reason that diversification matters, this is diversification shown to you as if like there's a range of outcomes. I like this because the reason why I drew this is that even if you pick the best stock, which is up here, you know, it's pretty good. That's like, to be honest, not to brag, but Pro Medicus is the best stock in Australia over the past 10 years, may even be over the past 20 years, and may even be one of the best in the world over the past 10 years. And I was just flat out lucky. So even if you pick the best stock, right? If you diversify, basically what you're doing is you're saying, I'm never going to be as bad as the worst, but I'm never going to be as good as the best. Now, obviously, if I put 100% of my portfolio at the time in Pro Medicus, I'd probably be living in Positano right now, going between my yacht and the beach club. But I'm not, and that's okay. But I could have done the opposite. I could have put all my money in the worst stock, and who knows where I'd be then. Not Positano is the answer. So by diversifying, we don't get the best, we don't get the worst, we get something in between. Here's another diversification chart, which shows you how actually it works. I know a lot of my finance peers have taken my chart and then put it into their own literature and put it into their own fancy things. That's cool. You're more than welcome to use it. I would appreciate a reference. But if at all in the name of education, you take it, you use it, fine, no worries. What this chart shows is the true benefits of investing. Remember how I said before, and I'll get my Mr. Squiggle out. I'll use blue, that seems to work, yep. Remember how I said before, in stockbrokers terms, there used to be this idea of a race to 30 stocks. So basically what they would be saying is, dear Mr. and Mrs. Smith, you shouldn't invest in one stock, you should invest in this many stocks, which is say 30, right? So this is where the 30 goes. You should invest in 30 stocks because the level of your risk is going to be different to if you just invested in one. That's diversification, right? But as any of you will know, even if you diversify, like let's say you just own one ETF and it's the ASX 300, it's a very diversified ETF, you get the stock market return, you still get some risk. There's a level of risk that you can never, ever get rid of when it comes to investing. That is investing. Things go backwards from time to time. from one day to the next, from one period to the next, things go backwards. But over the long term, you tend to get this long, nice, smooth uptick. So what we're saying is, even though you use ETFs, expect things to go up and down. That's normal. But what you'll get is a smoother journey because you're effectively instantly coming down here. And in the case of VAS, you've got 300 stocks, not 30. And the data tends to suggest that after 30 stocks in a diversified portfolio, the benefits of diversification are not that big. Final chart before we get to actual ETFs and I start answering your questions is why behavior matters. Mitchell Snedden, who's the head of funds management at Rask, introduced me to a really important study that I'd long forgotten about, and it's called the DALBAR study, DALBAR. And what it shows is that over the long run, investors in funds, so it could be ETFs, could be managed funds, could be super funds, could be whatever, investors in the funds do worse than the funds. And I was thinking, how do you do worse than the thing that you're invested in? Does that make sense? How could you do worse than that? The answer is pure and simple. It's emotion. I'll see if I've got this chart. No. Buy high, sell low, repeat. So there's this kind of cool little thing. I think this is, so this one. So this is a fantastic chart from Steve Pomeranz here. And it shows you that most people buy at the high point, sell at the low point, and then they just repeat until they're broke. And it's kind of said in jest. But the idea is that basically people do worse than their investment strategy because they freak out. And there's one study that tracks that, and it's called the DALBAR study, and it's followed people for like 35 years. And you can see it here. It shows that Mitchell did this study and basically showed that had you invested in a particular investment, your return would have been 158,000. But your actual return, because of the behavior element, was 72,000, meaning that you lost out on this much return. Now, a lot of people don't think about the sleep at night factor, but if you think about it, just step back for a moment and think, instead of worrying about which stocks you're buying and freaking out over, well, Nvidia fell 15% in a single day this month. It might be a good stock, but it fell and I sold. Or, I bought that weird cryptocurrency and it's down and now I've sold out and I've lost money. What people don't talk about enough is how it makes you feel. And what I mean by that is, it is vitally important that when you feel that you're in control of your investments. So even though ETFs might not be the best thing in the world, how do they make you feel? Do they make you feel okay? I actually believe one of the reasons that all of us should consider seeing a financial advisor is not because the financial advisor is going to come out and wave some wand in our face and be like, oh, look, now you're solved. One of the great things that financial advisors often tell me is that they're not magicians. And so the benefit of seeing a financial advisor is it actually puts a barrier between you and mistakes. Navar's just come in and said, Navar is the founder of Navexa. He's the one who puts all this together for us. So Navar, welcome, sir. You can sign up to Navexa. There's a free link in the below the video in the description. Rask doesn't make anything from that. We don't make anything from it. Navar would, I'm sure, if you took up a subscription, and you should, because it's worth it. I'll get to that in a sec. But the key thing is that good behavior and how things make you feel is really important. And ETFs, because they are more simple, because they do tell you what they do, they're fully transparent. There's no mystery. Like, you can see everything that's inside an ETF by visiting the ETF provider's website. You just go to the ETF provider's website, or Vanguard in this case, or BetaShares, and it will tell you what's inside it. That seems like, whenever I tell my wife this, I'm like, yeah, so get this right. Fund managers don't need to tell you what you're invested in, and financial planners, they don't have to tell you what you're invested in. And she's always like, what? I'm like, yeah, no, that's just how finance works. They don't tell you. And she's like, but it's my money. I'm like, yeah, but I mean, hey, don't worry about it. With an ETF, you get full visibility 24/7. So I think it was Luke that mentioned the A200 ETF earlier on. You can go to the BetaShares website, the issuer of that ETF. You can scroll down and you can see all the portfolio holdings every single day. That's very different to literally every type of finance that's come before it. And that's the way ETFs are built, is they are fully transparent. Okay, so I've got two more things and then we'll just get into ETFs. So how do you actually, like once you buy an ETF, what do you actually do? It's important to understand that an ETF is a trust. It's not a company. So what that means is BHP is a company. VAS, which is the shares ETF, is a trust. T for trust, C for company. Exchange traded fund, that's what an ETF is. So let's talk about this just quickly, how tax works. Let's do a 30-second overview. So in a trust or in an ETF, so it's a trust, I'll go ETF. What happens is you are over here. This is you. This is we'll say this is Navar, saying that it's here today. So Navar invests in the ETF. The ETF invests in shares, say like Apple or Google or BHP or whatever. So Navar's invested in the ETF. The ETF goes and buys the shares, and there's like hundreds of these things, right? Typically, not just one. What happens is Navar here is actually getting units. So you will see something comes back to him. It's called units. It's not called shares. And that's why we have something. That's why when you see an ETF, it says distribution. It doesn't say dividend. It's the same thing. It's cash coming back to you, cash money. But you get units. You don't get shares. So keep that in mind. Navar will see in his Navexa account. So if he clicks on this, he will see that he's got the ETF, right? And what he sees is he sees the income. He sees all the stuff that he's got in his account. He could see the income, and the income, although it doesn't have any yet, it would be something called a distribution. Now, what happens is when this company, let's say it's CBA, when CBA pays its dividend, which it does pretty often, it pays a dividend, right? Div. That money goes back into the ETF. And because Navar owns the ETF, at the end of the tax year, all of those dividends have to get added up. It's like boom, boom, boom. All right, that's Navar's amount. Let's send it back to him as a distribution. So then Navar has to report it to the ATO. Pretty simple, right? He goes and says, hey, ATO, this is all the income that I got, blah, 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 blah. Now, the key point is this. In this situation, the ETF has to distribute the income. Legally, it is required to distribute all of the income that the investors have inside it. Otherwise, it pays an ungodly amount of tax. So the ETFs, that's why at June 30th, I don't know what's a good example of this. Let's try FANG. That's why at June 30th, the ETFs often fall. Where are we? June. It might not be reflected in this chart. So the ETF often fall around June 30th because all of the dividends that are built up inside get paid out. It's kind of like this one here, this BetaShares one. If we look at the price chart over the long term, so say we go 6 months, you can see this is an ETF that just invests in savings accounts. So what happens here is at the beginning of the month, it starts to earn interest from the savings accounts over the month. And then at the end of the month, it pays it out to all of the investors. And the same thing again next month. It goes up, pays it out, goes up, pays it out, goes up, pays it out. Now, that is one of the reasons that this happens is because it's an ETF. Now, this is where things get a bit different and how you report them differently on your tax return. When there's no ETF in the middle, like this thing here, what happens is, it's going to change color. What happens is, Navar in this instance, he wants to buy shares of CBA. So what he does is he just buys CBA directly like a dividend stock because he's like, hey, I think CBA is good. and he'll get shares back. Shares, not units. Now, the difference is if CBA makes a profit, right? If CBA makes a profit, it does not have to pay a dividend. It can keep the dividends inside it and keep reinvesting them again and again and again and again. It doesn't have, it's not legally obliged to pay a dividend, whereas an ETF has to pay it out. And this is the real reason why some people don't like ETFs for tax efficiency. Like for people that earn a lot of money, they might be like, well, I don't want to take the income because then I have to pay tax on it. I don't want this because I'll have to pay tax on it. So what they do is they prefer to invest in companies like individual shares or those types of things instead of ETFs. However, we've got to a point now where many of the ETFs don't have huge tax burdens. So it's okay, and anyone can use them now. And they actually turn out to be very tax efficient compared to other things. Now, I know I went down a rabbit hole there, but I'm going to explain to you how you don't even need to worry about all that mumbo jumbo. I just wanted it on the record. So in 6 months, if we refer back to this episode, someone will know what I'm talking about. Every year, you'll get an annual tax statement from your ETF. You do not get that from share investing. An annual tax statement applies to ETFs and to managed funds only, and you'll get that sent in the mail to you from BetaShares or from Vanguard or from iShares or GlobalX or whoever you invest in. I've already mentioned that all tax is passed to you. You can, or you should, do two things. If you get a letter in the mail and it comes from Computershare or it comes from Link Market Services, so if it comes from something like this, so financial freedom, do you mean that CBA reinvests in themselves? Yeah, so a company, financial freedom, can reinvest in itself. It doesn't buy more shares, it just keeps reinvesting in itself. I'll explain more in a sec. But if you get an email or if you get a letter in the mail from these guys, Computershare or Link Market Service, what this is the company that organizes all of the information for the ETF. So if you get that and you haven't filled out your tax file number on Computershare or Link, and you haven't given them your appropriate bank details, there's a chance you'll have more tax withheld. So you want to do that, right, as a priority. Go in, you can create an account. For example, if you have like 5 different ETFs and they all send you Computershare letters, go in and create an account. You can also manage some of this at your brokerage level, but that's not always the case. Where was I? There we go. So go and set that up. That only happens once you buy the ETFs, all right, guys? Like you can't set it up in advance. You need to buy them and then set it up. Do you get franking credits with ETFs? Absolutely you do. People still get confused about this. If CBA pays a dividend, I'll change color. If CBA pays a dividend and that dividend has franking credits and you are eligible to receive franking credits, you will get your distribution, but the franking credits will also be stored against your name at the ATO. So you can claim franking credits when you do your tax return. You get this nice little tax statement that shows it all. It does take a couple of months after the financial year. Vanguard annual tax statement. Let's see if there's an example. So here you go. So this is, there's one from Rask Media. Here we go. So if we can click on this, so you can see, it's pretty hard to see actually, but trust me on this. I'll try and zoom in. I can't zoom in. Basically, it shows all of the different types of income that you receive, including franking credits up the top, unfranked dividends, franking, you got it all there. And it's got all the codes and you can put that into your tax return or do what I do and just hand it to my tax account and go here. Now, so how do you make this life easier? So how do we make this easier? What we do is we use something like Navexa or ShareSite. Again, I don't get anything for mentioning this. And Navar is here today. I'm sure he'd be happy to answer any of your Navexa questions in the chat. But basically how it works, let's use let's use our actual portfolios at Rask. So this is our ETF portfolio, Jupiter, which is our high growth strategy. I don't actually have any here, but let's say I've put in an ETF right? And inside that ETF, there is a bunch of different stuff going on. I can click on one of these things and I can see, if I go to this here, the income, I can see income coming into this ETF shareholding. Or if I go back, let's go to a different one. Let's go to the AAA ETF. I go income. You can see all of the income that I've received. The key thing, and the reason that you use this software, is because if you don't use this software, you'll have to use a spreadsheet, because the ATO still wants you to report your tax even if you don't use this software. You still need to do it. This software makes it easier. So basically, this would be like ShareSite and Navexa are here, right? So that's where or probably more like this. This is where they live. And what they do is, if you set it up correctly, whether you use ComSec, Perla, SelfWealth, whatever platform you use to buy your ETFs, it can automatically read all of the income you're receiving and then add them all up. And then at the end of the year, you can see in one page all of your income, all of your franking credits, all of this, as long as you've set it up correctly, and you just go boom and just give that straight to your accountant. And it saves your accountant hours of time and saves you money, even though the subscription costs you money. Anyway, this is not a flat out pitch, but it's just a simple reality, is that you have to do your tax return. So you may as well just use software to do it. Yes, it costs you a bit of money. It's not that, it actually probably saves you money, because your accountant will be just running around thinking what the heck's going on. So that's how that works. Now let's get into some ETFs. I shared an email yesterday, for those of you that are on the emailing list, talking about the most popular ETFs in Australia. Now, what I've done, and what you should do, ASX Monthly ETF, is you should download this monthly report that comes from the ASX itself. And if you go in here, it shows you, it takes a few days for it to get updated, but you can download in Excel format. I'll zoom in. You can download the Excel version, or you can download the PDF version. And in here, you can see all of the different stuff. So this is all the data that you would probably want on ETFs, which they call ETPs. And there's a reason for that, ETPs. But they've also got funds. They've also got LICs. They've got REITs. They've got all this other stuff. But you can go in here and you can see what are the most popular ETFs. You can see what are people buying. Which sector are they in? And you can also analyze, this is the key point. If we go to an ETF, like let's say we've got A200, which was brought up before, and we scroll right across, we can see the historical yield, right? I'll come back to this in a minute. You can see the historical yield, but we can also see the long-term total return. Total meaning income plus growth. Really important to remember. Income plus growth. You see it's 9% for this one. And that's would be net of fees. So the fees are taken out already. But say, for example, when people go into Google and they just push in A200 ETF and they look at the price like this, or in your brokerage account, for example, what you're actually seeing is not the income. You're just seeing the share price, the growth. You're missing out on the income, which is as much as half of the return. So you've got to look in an actual database like this that shows you the total return. I hope that makes sense. Now, this is like every month, this is like required reading for me. I go in here and I look at this, I check on the numbers, I export as Excel, I analyze the data. This is what I look at as a professional investor. If you don't have access to like a $20,000 Bloomberg terminal or some fancy software, which you don't really need, you can just use this. And it's a great resource put out by the ASX. But I wanted to come back to this thing right here. A lot of people, when they look at ETFs, they make a really, really, really big mistake. They look at an ETF and they look at something called the yield. So yield, right? They look for this thing because they're so used to looking for things called dividend yield, right? Dividend yield is what you use when you analyze a share. You compare the current year's dividends to the share price to get a percentage. That does not work for ETFs. It does not work. It might show you something, but it is a mistake. Can you please cite the ASX link for that data? Yeah, sure. It's just right here, Gareth. I'm popping it in the chat now. The reason that this simple calculation does not work for ETFs is because you don't get a dividend, you get a distribution. Remember this thing here? You get a distribution. And that distribution doesn't just include the profits of the company. It's not like you get profits paid back to you. You also get a bunch of other tax stuff. You get franking credits, you get foreign income, you get capital gains is paid back to you. So where'd my little widget go? Here we go. You get all this stuff. Look at all these different things in here. When you get a dividend, you just get the cash paid to you. And then you can claim the franking credits later on. But you just get the cash. It just hits your bank account. That goes in your tax return. Bada bing, bada boom. But when it comes to ETFs, it's not just income. It's a bunch of other stuff. So be very careful. And I've seen a lot of these videos on social media lately where people say, this is a really high income ETF. No, it's not. What's actually happening is they're taking part of the investment in the ETF and paying that to you. It's not actually yield. So when you look at the yield, you can use this. This is a trustworthy resource, or you can go to the ETF provider's website. What did I just type in then? Like this right here. You can go to the ETF provider's website. Thanks for answering questions in the chat, Navar. That's great. Thank you, mate. So if we go to, I think it's performance. No, it's not, Owen. If we go to and it's not here, Vanguard, where have you put it? Okay, so Vanguard hasn't even he put the thing in, made it obvious for people. I'll go to, let's see if our friends at BetaShares have done it for us. So if you go to the BetaShares website and you scroll down and you go to yield information, what you can see here is you can see the yield, 12-month distribution yield is 3.5%. That's what you should be focusing on, 12-month distribution yield. Some people just take the whole amount of investment and they think that that is the income. And that's what you see on most broker websites, is it's incorrect. Now, if you're struggling for that, you can just use something like Navexa or ShareSite or one of the more advanced tools, and it will actually show you a realistic view of what actually happens. I hope that makes sense. Okay, so now back to our ETFs. We've got, look at all these squiggles. So what I did is I run an analysis of the most popular ETFs in Australia, but I didn't just go for the biggest ones and just list them, because if I did that, they'd all be from the same type of sector. Remember how I said that like investing is like putting a plate of food in front of you? If I just got the biggest ones, we'd just have potatoes we just have different versions of potatoes or pumpkin on the plate. We'd have nothing else because there's no room for anything else. So what I've done is gone into each category. Onion category, meat category, lamb category, whatever. And I've got all the biggest ones from each of those, the ones that matter. There's a bunch of crap out there, but these are the ones that matter. So in Australian shares, the biggest ETF is the VAS ETF, the Vanguard ETF. It's got 16 billion in it. It is the biggest ETF in Australia. Next, and each of these, by the way, I also like, the reason that I put each of these in here is because they will have an educational takeaway from each of the things that you can remember. I'll use a different color. So this is the ASX 300. This is the most popular ETF because it just invests in all the 300 biggest Australian shares. Pretty obvious. This next one is very interesting. Most people think that ETFs are just index funds. So they're boring. They just track the entire stock market. That's not true. Some ETFs use active investment strategies, like the Magellan Fund, which is there's people like human beings like you and I picking which stocks go inside it. And it just happens to be in an ETF form. You can just buy and sell it like an ETF. I think of an ETF kind of like a box of favorites. You know, when you get the box of favorites, it's got like different Turkish delight, it's got a bunch of different chocolates and stuff in there. What matters is not the box. Who cares about the box? What matters is inside it. And so inside the box, if an ETF is just the thing around the outside the box, that's what an ETF is. It's like the thing that holds all the investments. What goes inside is what matters. An active strategy is like saying you trust someone else to pick the best chocolates and put those in there. You seem to know chocolate better than I do. You put the best chocolates in there and I'll take that to the party tonight to give to my friend. Whereas with the first one, with this one, it's just like whatever's the biggest ones go in. So like BHP, whatever, Tarwin, you said, does rules-based investing using factors rules outperform active management? That's a good question. It's very nuanced, Tarwin. I'll try and get to that if I have time. Next on the list, we've got global shares or just US. I say global shares, but it's US shares. It's the IVV ETF. This is it's got 8.556 billion into it. Now, the other one that is probably just as big is VGS. This is the global shares. But IVV invests in United States stocks. Before these ETFs were really easy to access from Australia, people would have to open US brokerage accounts, buy Apple shares, buy Microsoft shares. But you don't have to do that anymore. You can just use an ETF. And then you can just buy the ETF and then let the ETF invest for you overseas. Owen, you've got ETF mini series, Rask ETF beginner mini series. So Owen's just reminded me of something in the chat. So we've got two things. This one right here. Okay, so I'm going to put this in the chat right now. This ETF mini series on our YouTube channel is free. It is the most popular single playlist that we've ever created. We also have a free ETF investing course. I didn't want to plug this, but seeing that you brought it up, Owen, I'll mention it. This is a free course, and it takes you through how to analyze ETFs. It's totally free. There's no like BS in there. It just tells you how to do things. There's quizzes that will test your knowledge. There's also a checklist, but it's free. We've got nearly 30,000 students enrolled. It's amazing. I love it. Next up, we've got the AAA cash ETF. This ETF just invests in cash. Just goes and takes your money and puts it in a bank account. The reason that you use it, there's been a lot of questions about this. The reason that you use it is because your brokerage account doesn't pay you interest. So if you have a lot of cash, like a retiree, and you're just sitting on cash and you're ready to invest, but you don't know what to buy yet, you may as well invest in this ETF. So at least you're earning some interest. Whereas most brokerage accounts don't always do that. Heath, you said that's the one I've had clients do. Oh, this ETF course. Thanks, Heath. Yeah, this is a free course. This is our most popular course of all time. The second most popular course is the property course. But again, it's free, so feel free to go and use it. Next up, we've got the gold ETF from GlobalX. Full disclosure, GlobalX and BetaShares are long-term sponsors of Rask Podcast. I didn't include that for this reason. It's just because it is the biggest gold ETF. So in the commodity sector, you can invest in gold. And all that happens is GlobalX takes your money and goes and buys gold and puts it in a vault in London. That's literally how it works. And then you benefit if gold goes up, which it has this year. Next up, we've got property. So in the property bucket or property type of investment, we've got VAP. This is the biggest property ETF. Now, key point here is that this ETF does not go and buy Jane and Jill's house down the street. What it does, this is a really important point, okay, is this ETF doesn't go and buy actual properties. It buys the shares of companies that own properties, or like Metricon, or it will buy shares or units in a real estate investment trust. So like Charter Hall, Center Group, the owner of Westfield, that type of thing. So it goes and buys those. It doesn't actually go and buy a physical property, because if it did that and everyone wanted to sell, it would have to sell all its property. So it doesn't do that. It just buys the shares of the property companies, like the Bunnings warehouses and that sort of stuff. Aussie bonds. So the biggest one is IAF. We're invested in this. This just is a government bond ETF. So you put your money in, and then that money is effectively lent to the government and you get income. Bonds are really good this year. They're really, really good. I love and invest in them. Avo, you've said REIT ETFs have high tax rates, ? So not really, Avo. So what happens is, where's my, I'm on Mr. Squiggle already. So in the case of one of those property ETFs, so if you're investing in the ETF, all that ETF is a trust, remember that, And the property ETFs just go and invest in, let's do a different shape. Let's go like that. The property ETFs just go and invest in a REIT, right? REIT, REIT, which owns the property. It owns Bunnings. It owns the office buildings and that. Now, these things are also a trust. So they're both trusts. So this thing generates rental income, pays that rental income into this ETF. That ETF then pays it back to you. The only time it incurs a lot of tax is if they break the rules and they don't pay that income back. That's when trusts pay a lot of tax. Hope that makes sense. Speak to your tax agent. Moving on. So IAF, there are different rules, Avo, you know about tax rates for bonds in the US. There are certain benefits to investing in bonds in the US that we don't have in Australia. Global bonds, the biggest ETF is VBND. We're invested in this. This is just government bonds. It's like loaning money to the US government. The biggest thematic ETF in the country, as far as my knowledge is this ETF from it's an IXJ ETF. So if we push this into Google, I could just put it into Perla. Let's go into Perla. This is one of the brokering platforms, long-term sponsor of Rask. Bada bing, bada boom. Just get some. Come on, let me in. Please let me in. So if we go in here and we go IXJ, ticker symbol IXJ, click on it. So if we go in here, it's got some information about what we could see. It's over 10 years, the performance. We've got the type of investment. So inside this ETF, there's Eli Lilly, United Health, Johnson & Johnson, AbbVie, I don't know how to pronounce that, Merck & Co. And you can see all of the different holdings inside that ETF, right? What it does is it invests in healthcare companies. So if you think, hey, the world's getting older, hey, Owen's looking pretty sick right now, he's going to need the doctor, I should go and invest in this global healthcare ETF. What it does is it just picks stocks from the healthcare industry and owns them. Pretty simple. Instead of buying everything, it just owns those. In emerging markets, the biggest ETF in the country is the IEM ETF. We did a podcast on this, Australian Finance podcast episode. It goes out tomorrow. So Australian Finance podcast is available. Australian Finance podcast. It goes out tomorrow morning on our YouTube channel. So if you're interested, it will be somewhere in here. It'll be shown. So you can see all of the podcasts here, or you can just get it on Apple. Hey, by the way, guys, this episode right here, this is an absolutely wonderful podcast. Paul Clitheroe here is he's gold, honestly. I'll put a link in the show notes. He's just a legend. So go and check that out. That's a great podcast, by the way, while I got you. Next ETF is infrastructure. So again, just like the property ETF, emerging markets. What are emerging markets? This is like China. Depending on how you define emerging markets, places like South Korea, India, those types of investments. Infrastructure. So again, just like the property one here, what's important is that, like, if you invest in this thing, it doesn't go and buy the MCG. It doesn't go and buy Optus Stadium. It doesn't go and buy a toll road. Or if, like, me and the geese put $50 in, it doesn't go and build a new toll road in Sydney. That's not how it works. When they say infrastructure, don't be fooled. All it does is it takes your money and puts it into an ETF, right? Which is just a trust. And that ETF just goes and buys shares of toll road companies, right? So things like Transurban, for example. Now, this one is a global infrastructure. Sometimes they can invest in funds as well, not just shares. But realistically, it's like investing in one thing to invest in another thing. If I sound a little bit cynical, it's because I am. So those are the most popular 11 ETFs based on the different buckets. And what it ultimately shows you, and what I wanted to illustrate today, is not that these are the best ones, because remember, it's not about that. It's about what you do with it, how you put it together and stay invested. What I wanted to show you is that an ETF can now mean many different things. You can now use the power of an ETF, which is low cost, transparent, easy to buy and sell, and automate your tax reporting, by the way. And you can invest in all types of stuff. It doesn't have to be boring. You can invest in an active strategy. You can invest in the US, China, bonds, property, gold, crypto ETFs, like cash. You can build an entire core portfolio from ETFs and harness the power of low fees, easy tax reporting, feel better when you go to sleep at night, have diversification, not worry about having to pick extra stocks, and maybe you can go spend some time playing golf or fishing or hanging out with your friends on the weekend. Donate your time to charity. You won't be paying real silly fees. You don't have to get caught up in stupid academic journals about finance. You can just treat your investing as if you're eating a diversified plate of food. You can dollar cost average every month and have it all bundled up for you. And it's simple. Like at the end of the day, it's simple. So that is my spiel. Obviously, we don't just talk about ETFs, but I'm making the case for ETFs today, aren't I? So that's that. Now, there are some questions. Okay. Warren. Warren, I've got to love that name. He asked the same one as Ahmed here, which is that you may not want to advise, but what weighting would be assigned to these 11? Good question. Same one here. Nice list of ETFs. Thanks, Owen. Are you going to cover allocation? Yeah, I can cover that in a sec. So I'll answer both of those. Jenny, you've said Paul Clitheroe is so down to earth and logical. God, yeah, he is. Iman, you said, I am behind you. You mentioned to fill in the computer share document, even if we filled the broker's tax info. Okay, yeah, okay. Let's take all these. Let's get into it. Let's answer some questions. Okay, so how do we weight these things? All right, blink twice and you'll miss it because here's the secret sauce. Just kidding. Okay, so if you go to our website, actually, let's log out as if you weren't an investor with us. If you go to our website and you see the different strategies, you will be able to see some really secret sauce that's open to the public. All right, guys. Oh yeah, Luke, got your question. Thanks, mate. So if you click on the strategy that we follow, right? You see it here, and you go down and you click on this thing that says asset allocation. You can actually see how much we've got invested in different buckets. Now that's just a high level, but you can also see which ETFs we invest in, right? And if you follow along with Rask enough, you'll be able to make it up. You'll be able to understand why we do what we do, even if you're not a member or even if you're not an investor. But that kind of shows you how we think about it. So basically what we're saying publicly for free on our website is, hey, here's how we're doing it. Now, obviously, if you want to invest with us or you want to become a member of our core service, you'll get like the full breakdowns, but that's just a general gist. For disclosure, I will tell you which ETFs of this list that we are currently invested in to make it easy for you. Red, VS, IVV, AAA, IAF, VBND, and we would consider the new version of the gold ETF, which is GXLD. So there's a new one that's come out as lower fee. We'd consider to be honest, we as investors, we would consider all of these part of our core portfolio at least one time. This thing here, we don't tend to do thematics in our core portfolio. We would leave them for our investors to do in their satellite. So remember, the core is just the low cost like building blocks. It's kind of like the broccoli and the cauliflower, the potato, and if you eat meat, it's the meat. That's the core portfolio. Now, if you want to chuck some herbs and spices on there and you want a bit of healthcare, you want a bit of who knows what, that goes on a different side plate, right? That's your dessert or something else. Does that make sense? So the other thing to keep in mind, if you want to ask me any questions after this, you'll find everything in the show notes, but take a free course or just come and have a chat with us over on the community. It's free. Everyone in there talks about the different ETFs. I should have put this link in the show notes, but everyone talks like daily in here about different ETFs and whatever. So you can go and check that out. Now, Luke, so you've got, Luke, a good question here about AQLT versus A200. So with AQLT, what you're doing is you've got, basically you're saying, it's like, if we keep butchering this analogy, and this butchering part will come into the fore in just a moment. But let's say you like to eat meat, right? Let's say you're a meat eater, Luke. I don't know if you are, but let's say you are. But you're only interested in lean meats because you think they're better for you. That's effectively what you're doing by saying, I'm going to invest in a quality ETF. So it takes all the meat and it says only the lean meats come here. And that's what you put on your plate. It's exactly the same thing. You've got 200 shares in the A200 ETF, which is an everything ETF. And then you're saying with AQLT, I only want the ones that have high returns on equity and they have low amounts of debt. I'm just going to invest with them. There was another question or comment that came through before about the Qual ETF. The biggest ETF in Australia that is called a factor ETF, meaning that it just targets companies with a specific factor or trait or characteristic, is Qual. So I'll take both of these in tandem, if I may, Luke. So, because I know people like this ETF. So this ETF from VanEck, QUAL, Quality, invests in high quality companies from around the world. Now, if we click on it and we go down, we see it's got 300 shares in it. It's one of the biggest ETFs in Australia, by the way. It's not the cheapest ETF, but it's one of the biggest. If we come down, what you will know in this ETF is if you go in, you'll see the biggest shareholdings are in NVIDIA, Apple, Facebook / Meta, Microsoft. Oh, look, there's Eli Lilly again, Novo Nordisk, Alphabet, Visa, blah, 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 blah. A lot of tech stocks, right? Because what if you think of like, oh, what's the best quality company I can think of? You probably pick up your iPhone, you'd be like, Apple. You probably go, oh, Microsoft. They're profitable, right? So what ends up happening is people end up with too many ETFs doing the same thing and investing in the same companies. So what Navar did from Navexa is he created this amazing tool, and I'll put a link in the comments. It's a fun comparison tool. You can just Google it yourself. What he did was he created this tool, and it shows you the performance of ETFs side by side, as well as the risk measures. And you can see here, right, that the Qual ETF and IVV compared very similarly over the last year. You can see how they performed, right? The problem is if people add a quality ETF like this right beside a vanilla one, like a normal one, they tend to do the same thing. So there's a lot of what we call overlap. Now let's take a different one. AQLT, which you mentioned. Add that. And let's go A200, which you also mentioned. And here we will see quite a different performance. We can see AQLT did a bit better, like quite a bit better over the past year. Doesn't have the longer term track record yet. And I'd be willing to bet that this ETF invests more in technology stocks. So what this basically means, when I see this, Luke, and I see them side by side and they're so different, it actually is a good thing for me, because what it means is that, hey, it may actually be worth thinking about this ETF alongside the vanilla one because it does do something different. Whereas in the case of the Qual ETF, a lot of investors have significant overlap in what they do. So that's actually quite interesting to me. Look, I didn't actually know that that was how it performed over the past year. If I go AQLT, and I'll share my screen again. And if I look inside it, I'm interested now to know why it did that. Okay, so inside this ETF, we still got Telstra, Commonwealth Bank, Wesfarmers, BHP. But what's interesting is the way they're weighted. So BHP is the biggest company in the country. So in A200, that would be the biggest shareholding. Telstra would not be at the top. Commonwealth Bank would be second, which it is here as well. That's quite interesting, Luke. I would have to take this on notice, good sir. So, yeah. Oh, there were some good questions from before. All right, guys. I reckon we can go for another 5 or 10. Imi, you've said, what about the A200 ETF? Imi, I get asked a lot about, well, why do you invest with VAS and not A200? Why do you invest with VAS and not IOZ or STW? All of those ETFs I just mentioned do basically the same thing. So it would be like you and me having a conversation. I'm coming over to your house and you're like, hey, do you want porterhouse or do you want Scotch fillet or do you want T-bone? And I'd be like, listen, Imi, it's all good. Just pick one. Doesn't matter. It's the same. That's basically what we're comparing. And so if I talk about VAS and you talk about A200 or someone else talks about whatever, like the reality is there's a small fee difference. They track slightly different amounts of stocks, but just generally speaking, general advice only here, the ETFs are very comparable. Okay, okay, I can answer a couple more questions. Cassius, this is a good question. If my financial advisor says I need 2 years of cash buffer, is the AAA ETF, cash ETF, a good place to store it? Better than bank interest rates? I tell you what, I can't give you personal advice here, Cassius, but what I can do is I can share that article with you, which I just put in the chat. The thing for me is I put all of our emergency savings, so all of our living expenses are always going into our offset account attached to our mortgage. Now, as retirees in the audience, you may not have a mortgage. So what's the next best place to put money? Most often it's in an ETF. In a term deposit. So a lot of wealthy families, a lot of really wealthy families, what they do is they don't just use one term deposit. They might have 3 or 4 or 5 different term deposits, one for 5 year, one for 4 year, one for 3 years, one for 2 years, one for 1 year, as well as a cash savings account. And what they do is they do something called rolling. So they roll the ETFs, the term deposits. So when one needs to be renewed, they just renew it again. And then that way they've got a consistent stream of income, but they can also get longer term interest rates. Now, that's for living expenses and how many financial advisors treat that bucket. In a portfolio, however, typically people, like if you just think about what is portfolio money and what is living expenses, for portfolio money, a lot of people still use AAA or one of the cash ETFs. Hope that makes sense. Gareth, you've asked this question like 10 times, so I'll weigh in on it now. You've asked this question, which is, do ETFs pose liquidity risks? Now, at risk of losing half of everyone that's coming along, Luke, just quickly, he said, been a Rask core member for about 1.5 years and love the podcast and excellent resources. Thanks, Luke. I really appreciate that, mate. Back to the question, risks. So if we go into, I'll create a new one. So let's talk about risk in ETFs. And is there a big problem? Because if you Google this, if you Google something like risk and ETFs, you'll find that a lot of people that have said things in the past are now saying things about ETFs like there's a big problem. So basically what happens when an ETF is investing, so this is the E for ETF, what happens is, so this is you up here, Gareth, and you're just like happy as Larry. You got a big smile on your face. Look at that. Happy ETF investor. You put your money in. The ETF provider doesn't actually do what you think it does. What typically happens is when you put your money in, it's not the ETF provider that does the bidding. It's someone else. It's called a market maker. So market maker. Now, what happens is typically when you put your money into the ETF, you are buying it from the market maker, not from another investor, right? So you buy, and what you're getting are those units we talked about, units. And what the market maker does is the market maker goes and buys all of those 200 or 300 or 500 shares or bonds or whatever that are out there. It goes and buys all of them using its algorithms. It goes and goes, whoop, I'll buy all of those. And then what I'll do is I'll put them together And then let's say you've got the ETF provider. So I'll just do P, but in this case, it could be like Beta Shares, it could be Vanguard, it could be BlackRock, it could be whoever. They bundle up all of these shares, take them to the ETF provider, and the ETF provider gives them cash. This might seem complicated, but this system is actually wonderful, because what happens is you get your units, the market maker can go and buy all of the shares that belong inside the ETF, and the ETF provider just gives the cash and for all the units. This is just a general gist of it. And what happens is this organization right here makes sure that you can buy and sell your ETF. And why does that happen? Like, why does this organization exist? The reason that this organization here exists is because if the ETF's share price gets too high or too low, too far away from the value of all of the things inside it, what happens is this guy makes more profit, because if the value of the ETF falls and you click buy or sell or whatever, so you click buy, this guy here can go and collect all these shares, buy them all for less than they're worth, right? Or the true market price, and then package them up and sell it. So basically they get more cash. So they keep the market efficient. And that's something that's really difficult for people to wrap their heads around and for people to understand. Another thing that really happens here is that this organization is extremely well regulated, and anyone that meets the certain standards could do this. So this is an interesting thing. Heath, who's also in finance, he said here, no more liquidity risk than any other shares, as they have market makers. So you know the reason that ETFs show you everything that's inside their portfolio? You know this reason here, why they're all in there? It's not because it feels good for them to do it. It's actually so that this market maker knows which shares to go and buy and to put them inside the ETF so that they can get paid, right? So they know which shares to go and collect, because how else would they know if no one tells them? So that's why it's on the website. It's not just for your and my benefit for transparency. It's so they can go and collect it. And the key thing is that other market makers can join in. If this market maker starts making too much profit, another market maker will come in and do the same job for less. And that's what makes this system beautiful, is that everyone is incentivized to make the system more efficient. And remember, ETFs have been through two massive financial issues. Number one was the GFC, massive, probably the biggest in history financial crisis. And number two, they also survived the COVID crash. The key thing that we found out in the GFC was that some things should not be inside an ETF. Some of those things are what we call illiquid assets, so things that can't be bought and sold within a day. So even some things in Australia like hybrid securities, I have questions over. So hybrid securities are a different type. They're not shares, but they're not bonds. They're something else. You would never see a property inside an ETF, like an actual property, because it's just impossible. They can't go and buy and sell it in one day. So that's how the risks are managed. And I know there's a lot of like complicated jargon that I just mentioned. That's like if we were in university, this would be ETFs unit 304. This would not be 101. But that's the general gist, and they're very well regulated. There are risks, of course, in any investment, and things could go wrong, particularly in this thing here. But so far, for a few decades, things have worked out very well. I hope that... Imi, you said, what about the question about the TFN earlier? Do we still have to create an account on ComputerShare? So the question is about, like, do you have to use ComputerShare if you do this or whatever? The answer is yes. You should always just check with ComputerShare and Link Market Services. So Link Market Services is the other one. This one right here, this geezer. Okay, yep, sure. The reason why you would still check IMI is because for years and years and years, everyone's been telling the the ASX and ASIC, like the regulator, let us stop receiving paper. The stupid paper that you send us is useless. Just send us an email. So what some brokers have done, like Perla, TFN, oh no, it's like email statements, chess. So some of the more modern brokers, like this one right here, Perla, I think ComSec does it now, I'm not 100% sure, is they have like this very little simple thing, and you can send information to the share registries to tell them that, hey, I want email statements, I want to do this, I want to do that. But some of the brokers, some of the information is not always passed across easily. So the best thing to do is, if you do get one of these statements, log in, go to the website, log in using the information that you get, and make sure that your tax file number is reported. It's a pain in the ass, but it's only a pain in the ass because these websites are built before the internet was made. So they're just horrible. But if you've got the info, it's pretty straightforward. Gareth, I hope that makes sense. ETF is complicated. Yeah. A lot of the things in the world, first paper, is complicated. I don't know exactly how my Tesla drives. Like, I actually don't. I know it's electric. That's not a flex, by the way. I bought it for tax reasons, but I don't know exactly how it works, but I know it works. And I know how to like keep it running and make sure it's okay. They'll probably take over the world soon and do something with my car, but that's okay. Last question, because we're half an hour over. Okay, give me the full email here. I'll go DVC. You said, I'm trying to understand the risks of owning ETFs, specifically the risks of BetaShares / Vanguard ever collapsing. Is there insurance to help mitigate this situation? Must magic, Heath, yeah. Elon will soon start charging me to get in the car, I reckon. Who knows? I mean, Mercedes-Benz tried to charge people for heat warmers. So you can charge a subscription for anything these days. Anyway, so the question is, about the ETF providers collapsing. Yeah, sure. Cool. So one of the ways that this risk is mitigated. So here. So in the case of an ETF, right? Let's get rid of some of this random nonsense that I've got just floating around. So in the case of an ETF, what actually happens in this situation is ETFs are just like any individual shares, realistically. So if an ETF closes down, like let's say it goes out of business, and this happens a lot in the US now that there's so many goddamn ETFs, and it's happened here in Australia. Some ETFs have closed it down. What the ETF will do is it will send you a notification and it'll give you notice, and it'll say, Dear John Smith, your ETF is closing down. You have 30 days to either sell your shares, or if you do not sell your shares, we will sell all of the investments inside it and return the money to you. That's it. So the worst thing that happens when an ETF closes down is that you get a tax bill because you are a forced seller. You have to sell the ETF. Otherwise, like you have no choice because the ETF's closing down. The other thing is that if the ETF provider goes bust, so these dudes and Sheilas down the bottom here, what happens? In this instance, this organization is not just by itself existing out there. There are things called custodians. So a custodian is like a big global investment bank. And what happens is they don't actually hold your money in the BetaShares bank account. Like BetaShares doesn't wake up in the morning and check their NAB bank account and go, we got $40 billion. That's not how it works. It's held with a custodian, and those custodians are regulated, and their responsibility is a legal responsibility to the ETF itself. The ETF provider is just what we call a provider or manager, but there is a legal responsibility, something called a responsible entity, and they're regulated by ASIC. So in the case that one of these things goes down, what would most likely happen is another provider would be appointed to take over it, or liquidators would come in. It's your money, right? It's your money. Now, that's not to say they couldn't go bust, but they're so tightly regulated that, and eventually some of them will go bust, but it's your money. There's an additional layer that people could, there's an additional layer that people could take, and I believe this. You don't have to believe it. It's quite controversial in finance. Is that I would only ever use a broker that has HIN, HIN, chess sponsorship. HIN, holder identification number. This means that you always remain the legal owner of your investment. And who guarantees this? The ASX, the Australian Stock Exchange. Using their chess system. Jesus, we've got some acronyms. Chess, not the game, not the board game. It's something called chess. Deposit, chess, I don't know, something custodial holder deposit. I don't even know what it stands for anymore. Basically, what it means is that you are the legal and beneficial owner of the investments that you have with that broker. So say, for example, your broker, which actually sits in between you and the ETF, say that goes bust. Well, it doesn't, not that one. It doesn't matter. You can just transfer your HIN, the number that you have, and say, hey, this is my number. Can you go get the shares for me from the ASX? And the new broker then shows you the information. So that's an extra step. It costs me an extra $4 or $5 whenever I place a trade, but I don't care. I'd rather have an extra layer of protection than worry about all the other stuff. And that's exactly the system that we use for our portfolios, by the way. We're one of only a few in Australia that do it. That's why it says it right here at the top of the page on what we do. We offer that as part of people investing with us. It's not as easy to offer that as some of the others would say. Okay. All right, here we go. So are ETFs in a bubble? My answer is no. Daniel, last question. What's your favorite book from those on the shelf behind you? Well, the book that I'm reading recently is Plant Proof from Simon Hill. It's a great book. It's about like health and well-being. One of the best books I've read in the last few years. Definitely, where is it? It is not there. Definitely the best book that I've read in the last 5 years is Charlie Munger's Poor Almanac. Read it 3 times this year. But other than that, I don't even know, guys. I would say maybe, I think The Psychology of Money is up there somewhere from Morgan Housel. That's a great book. That's a really wonderful book. If you're just a new investor or you're just a more advanced investor, that's great. Cool. During the GFC, there was a large broking house that went bust that held all clients' shares as custodian. The liquidator considered them to be part of the company assets and many lost their money. So there you go. Heath has said that. Heath, what was the name of that? That wasn't BBY. That was much later, wasn't it? Or was it? I'm trying to remember the name. Anyway, what I am saying with I just prefer to invest with a HIN-based model. Where can I get an M&M toy? That thing there, Ray? We have to go back 30 years to get that toy. That is a collector's item right there, that bad boy. That dispenses M&Ms. It's not just a toy. It's a serious man's machine. Okay, that's it for today. We'll be back next Thursday. BBY was mostly HIN. That's good to know. Thanks. What was the name? Was it Storm Financial, Heath? What was the name of that? Can't say goodbye until I know the answer. It went bust. I will say goodbye. M&M store in New York. Maybe he got it there. No, it's just like it was one of those things that you could buy when you're like in the 1990s. I don't know what the name of it is. Please help me out, Heath. What was the name of the stockbroker that went bust? Opus Prime. Yes. Opus Prime. Key thing to remember is that don't take for granted where your money is held. Yeah, thank you, Sean. Don't take it for granted. I use a HIN. It seems more safer than anything else. And I'm not one of those people that are searching for the lowest brokerage fees because I know there's about 10,000 other things that are more important. Yeah. Okay, guys. Thank you so much for today. Sorry we went 40 minutes over the 1 hour podcast or live stream. Don't forget, there's a great podcast coming out tomorrow morning with Kate on the Australian Finance Podcast. that's it for me for now. Next week, we're talking about investing in US shares. So we're going to talk about stocks. Send me the names of your stocks. Use the Rask community. We'll talk about any companies you want to talk about that are good. Like, don't just send me some crap, but we'll talk about them. We'll analyze them. We'll talk about how to invest in US shares from Australia. The following week, we've got a property, and then that is done. That is our 5 foundational sessions done. And then we roll on. We start bringing some guests on and so on and so forth. So thank you, everyone, for today. Thank you, Warren. Thank you, everyone that came along and for the kind words about what we're doing at Rask. So really appreciate it. Thanks, Heath. Love to see you.